You probably have a lot of people, especially from this channel, telling you to invest in stocks. But when you come to think about it, investing in the stock market is not as easy as it looks. You need to analyze financial reports, research trends, and be ready for risks. However, it is universally known that thousands of people have become millionaires, if not billionaires, because of stock market investment. So, in this video, I will show you the basics of investing in the stock market as a beginner. Hey everyone, this is Capital Finance, your go-to channel for business ideas, entrepreneurship, investment, and personal finance. I know you're ready, so sit back, grab your pen and paper, and let's begin. Investing allows you to put money away while you're busy with other things and have that money work for you so that you may reap the benefits of your hard work in the future. Warren Buffett defines investing as the act of putting money in today to receive more money in the future. In order to see your money increase over time, you must invest it in a variety of different sorts of investment vehicles. Before you pass out from all these words, let's define what the stock market is first. What is the stock market? Any area where stock in publicly listed companies may be purchased, sold, and issued is considered a stock market in the broadest sense. Official exchanges, whether physical, electronic, or over-the-counter, are used to conduct these transactions, which follow a set of rules. It is common practice to refer to both the stock market and the stock exchange as the stock market. However, the latter word often refers to a subset. Buying and selling stocks on one or more of the stock exchanges that make up the global stock market is known as trading in the stock market. The stock market in a particular nation or area may consist of one or several exchanges. The New York Stock Exchange, or NYSE, and the Nasdaq are two of the most important stock exchanges in the United States. The stock market in the United States is comprised of these significant national exchanges and several minor exchanges operating around the country. How does it work? Market participants, such as you, can trade in shares and other qualified financial instruments with confidence, with zero to minimal operational risk, in a regulated and safe environment provided by stock markets. The stock markets function as primary and secondary markets, each following the norms laid down by the regulator. For the first time, firms can issue and sell their stock in a public offering, a process known as an IPO. On the stock market, IPO. Investment capital can be raised through this activity. That's basically what an initial public offering, or IPO, is all about. It's a way for a firm to get the word out about itself by selling a portion of its stock at a predetermined price to the general public. A marketplace where these shares may be sold is necessary for a firm to expedite this procedure. The stock market serves as the foundation for this market. This means that if all goes according to plan, the firm will be able to raise $50 million by selling 5 million shares at $10 per share. Investors will get shares of the firm, which they may retain for as long as they like to see their investment grow in value and receive any dividends that may be due. For its services, the stock exchange is paid by the firm and its financial partners, and it serves as a facilitator for the capital raising process. What kind of investor are you? Before making any financial commitments, ask yourself, what type of investor am I? Online brokers like Charles Schwab and Fidelity will question your investment objectives and risk tolerance when you register an account. If you remember from our previous videos, investing involves risk, but it can be minimized if you learn how to calculate it. If you're an investor, you probably have an idea of how you'd like to manage your money's growth, like the two we've just mentioned: stocks, bonds, ETFs, index funds, and mutual funds can all be purchased through more typical internet brokers. Now that you've learned what the stock market is, how it works, and what kind of investor you are, let's look at the ways on how to buy your first stock. Are you ready for it? Let's go. Number 1. Purchase stock using online brokers. Full-service brokers or cheap brokers are available. Standard brokerage services such as retirement planning, health insurance, and other financial concerns are all part of the full-service brokerage experience provided by full-service brokers. Most of your clients are pretty wealthy. Therefore, they may charge a lot of money for their services. They may take a percentage of your transactions, a proportion of your assets they manage, or even charge a monthly membership fee for their services. Full-service brokerages often need a minimum investment of at least $25,000 to open an account. On the other hand, traditional brokers can justify their high costs by providing personalized advice. There used to be a lot of discount brokers, but now they're the main thing. Many discount online brokers provide a set-it-and-forget-it Robo advisory service and facilities, allowing you to choose and place your own trades. Online brokers have evolved along with the financial services industry in the 21st century, adding new features like instructional content and mobile apps to their platforms. Number 2. Make use of robo-advisors. The robo-advisor emerged in the wake of the financial crisis of 2008 as a new type of investment advisor. John Stein and Ellie Broverman from Betterment, an investment company, are frequently cited as the industry's pioneers. Their goal was to reduce the price of financial advice for investors while also streamlining the process. Even renowned internet brokers like Charles Schwab have offered robo-like advising services since Betterment started. In a research by Charles Schwab, 58% of Americans expect to employ robo-guidance by 2025. A robo-advisor may be right for you if you want an algorithm to handle all of your investment choices, including tax loss harvesting and rebalancing. The success of index investing has proved that if your objective is to develop long-term wealth, a robo-advisor may be the best option for you. Number 3. Invest through your employer. If you're on a limited budget, invest no more than 1% of your annual salary in your company's retirement plan. The reality is that a gift of that size won't make a difference to you. Contributions to employer-sponsored retirement plans are deducted from your salary before taxation, making them even more affordable. It's okay to start with a 1% contribution and gradually increase it as your salary rises. The extra contributions won't be missed. Investments in mutual funds and even the stock of your own firm may already be part of your work-sponsored 401k retirement plan. As I've said before, investing comes with risks, which can be reduced if you know how to do it. So, what are these risks? Investing is putting money down today to earn more in the future. Certain asset classes and financial products are naturally more risky than others. As a result, there is always a chance that your investment will lose value. For this reason, risk management is an essential issue for investors, regardless of whether their financial goals are short or long-term. Risks in the stock market cannot be eradicated, but they can be minimized. So, how do you reduce risk when investing in the stock market? You must diversify your portfolio. Diversification is believed to be the only free lunch in the world of investments. If you diversify your investments into several asset classes, your total investment returns will be better protected. The phrase, "Don't put all of your eggs in one basket," might be interpreted as financial lingo. For diversification, stock investments will be the most difficult to diversify. The costs of investing in a high number of companies might have a negative impact on the portfolio. To create a well-diversified portfolio with a $1,000 investment, you may only be able to invest in 1 or 2 firms at the most. This will enhance the likelihood of a negative outcome. If you have any tiny quantity of money, you can start investing. As a rookie investor, you need to be aware of the limits you encounter. which is more involved than simply picking the proper investment. If you want to compare the commissions charged by different brokers, you'll need to conduct your research and determine the minimum deposit. With a modest quantity of money, it's unlikely that you'll be able to buy specific stocks and diversify well. Stock market is a tricky world that no one had ever mastered. You can, however, be an expert of this through constant research, experience, and failures. That's why if you finish this video, there's no doubt that you'll be a successful investor in no time. So, what are some publicly traded companies you know of, such as Apple? Let me know in the comment section below. I hope this video will help you in your journey to investing. As always, thank you for watching, and see you next time.